Financial Year 2022 media briefing. This media briefing will begin with a glimpse into company's numbers and trends for the annual and fourth quarter. It will be presented to you by our whole-time director and CFO, Mr. R. Shankaraman. Thereafter, Mr. Raman and our CEO and Managing Director, Mr. S.N. Subramanian, will address your queries. Let me now invite Mr. R. Shankaraman to present before you company's performance highlights for this quarter and the financial year ended on March 31st, 2022. Over to you, sir.
Thank you. Good evening. I think it's very good to see you in person after a break of 2 years. Thanks for making time to be here in our office this evening for our presentation on Q4 FY22. First and foremost, I think FY22 has been a dramatic year. We started the year with the pandemic in its variant 2, pretty severe for 3-4 months. Then we had prolonged monsoons, which went almost till the end of the calendar year. As the monsoons left, we had another variant of the pandemic, Omicron, visiting us. It put us back by a couple of months, and as Omicron receded, the war in Europe broke out. Series of events through the 4 quarters of the year, each having its own challenges. I think nobody in the corporate sector would have planned for such successive events, and that too of black swan nature. Yet, I think it is to the credit of the country, economy, industry, government, policymakers, that we've been able to steer through these challenges and proceed with optimism and hope. L&T has not been any different from this spirit of resilience that the country and the industry and the government displayed by and large. Notwithstanding all the headwinds that we have faced, we've been able to deliver yet another year of solid performance, thanks to tireless efforts of our staff, vendors, partners, subcontractors, and all the other stakeholders who actually stood shoulder to shoulder with us. Let me add my words of disclaimer that in the course of this interaction, we could have forward-looking statements and presentations, which as the year passes by could change in contours. So that's something that we normally disclaim. So how has the year been for us? Pretty solid, I should say. We closed the year with one of the strongest order inflows that we've ever had in a quarterly, in a quarter closing. In fact, what gives us confidence is the momentum appears strong as we close the year, and the prospect for the year ahead continues to look very encouraging and bright. The order book is getting larger by the year. It's growing, pretty diversified, and it's almost at $48 billion today as we speak. And it provides a lot of comfort for the revenue visibility for the company going forward for the next 2.5, maybe 3 years. We managed FY22 with growth in revenues on targeted lines. And the best part of this growth is we've been able to not incur further working capital to fund this growth. We've been able to manage our resources brilliantly to ensure that the revenue growth happens within the cash that we generated. So there was a very well orchestrated balancing act between cash, investment insights, progress on the projects, and billing and collection. The margin for the quarter and here as a whole does show signs of the stress that the input costs and cost of execution we have to bear. because all the disruption that I spoke to you about has caused inflation, supply chain constraints, and realignment of geopolitical equations. What this meant is that the commodities, the input prices became more expensive than what we targeted them to be. And the sourcing had to be changed on the go because the economic sanctions that were declared thick and fast meant that some of the sources were out of bounds. The liquidity has been well managed during the year. We've been able to generate adequate cash from our operations, and after paying the statutory taxes and meet all the related liabilities, we've been able to retire our debt as well. Consequently, the debt equity ratio for the year that we are closing in FY22 is lower than the debt equity we reported 1 year prior. We will see the details in the subsequent slide. We also believe that the turnaround in the return ratios are indicative of the path that we will walk as we move towards targeted better returns than what the COVID years have left us behind with. Just a few metrics to provide you the highlight of how we have fared. The detailed results are available with you, so I'm sparing our effort to go into the line items of those details. But the big picture, as I spoke to you about, the order inflow at 1.9 trillion rupees is a 10% growth over the 1.75 trillion that we reported in the year prior. And this achievement notwithstanding all the challenges that I mentioned to you earlier. I did speak about a very large and growing order book at 3.5 trillion rupees, largest ever that the company is reporting, which is a 9% growth over the 3.2 trillion of the prior year. Revenues have kept pace on planned lines, a 15% growth at 1.5 trillion rupees as compared to 1.3 trillion of the full year previous year. For efficiency of time, I'm focusing more on the yearly numbers. The quarterly numbers are visible to you in the charts. EBITDA has, for the year as a whole, grown by 10 basis points at 11.6%. But for the quarter that we just concluded, it is down by 100 basis points at 12.3%. The decline in EBITDA is largely on account of the costs of execution going up, thanks to the inflationary pressures all around, and also the fact that some of the claims and reimbursements that we were targeting in Q4 have got deferred to the subsequent quarters because the costs are incurred and accounted upfront, and the reimbursements and the claims get settled subsequently. So these are not hopefully value lost, but deferred to a later point in time. The operational profit after tax for the year as a whole is at 86 billion rupees, which is a 23% growth over the 70 billion of the previous year. And for the quarter at 36 billion rupees is a 6% growth. I'm making a distinction between operational PAT and overall PAT because in the year that went by earlier in FY21, you will recall, we sold a 60-year-old business, our electrical business, to Schneider and reported a significant gain in our financials. The exceptional nature of those income made sure that the profits that we reported for the previous year was 116 billion rupees, and it is 87 billion rupees for the current year, where we didn't have the benefit of any such large transactions, and hence it appears like 25% lower than the previous year. I hasten to draw your attention that this comparison is not really apple to apple, and the operating profits would be a more appropriate comparison to know the health of the business. The good news about achieving all these numbers is we've been able to get our net working capital down to 19.9% from 22.3%. I must acknowledge here the stellar efforts that our business teams have put in to make sure that we convert our work in progresses into outstandings and outstandings into cash. The return on net worth on a trailing 12-month basis at 11% for the year that has ended. If we exclude the exceptional gain of sale of electrical business, the return on net worth for the previous year was 10%. So there is a 100 basis points improvement in the return on net worth. But optically, the overall net worth is reported at 16.2 in the previous year as compared to 11 of the current year. The dividend that the board has recommended for shareholders' approval is 22 rupees per share, which is a 22% growth over the 18 rupees per share that was declared as normal dividend in the previous year. You will recall in the previous year, FY21, in addition to the normal dividend of 18 rupees, we also declared a special dividend of 18 rupees per share to celebrate and share the outcome of our sale of electrical business to Schneider. Looking at the performance in certain amount of granularity, let me start with orders. The orders that the company has won in Q4, which just concluded March 22, is 739 billion rupees, which is 46% over the 507 billion rupees of the year corresponding quarter of the previous year. Bulk of the growth in the order inflow has come in by the growth of 75% plus in the international business. 184 billion rupees of orders that we won in Q4 of the previous year actually has grown to 322 billion rupees in the current year. The order wins that we've reported in our hydrocarbon segment, power transmission distribution segment, etc., has contributed to this surge. Also, the fact, since these are consolidated numbers, the revenues of our IT services business are reflected as orders for statistical purposes, and the growth that the IT companies have reported in their respective numbers are also reflecting in the growth in the international numbers here. As far as the year as a whole is concerned, we have ended the year with 1.9 trillion rupees, which is 10% higher than the 1.75 trillion. And here the international orders have grown from 480 billion rupees to 841 billion rupees, once again excess of 75%. But the point to note is the domestic orders have declined from 1.2 trillion rupees to 1.08 trillion rupees. It is not out of place to mention here that the speed with which bids were put out and awards were given in the prior year, where the government and all the agencies, sponsoring agencies of the projects, were very keen to revive the economy from the direct impact of COVID, there has been a certain slowdown because of the other global events that I spoke to you about during the current year, which to some extent has been distracting. The markets have been in a churn, liquidities have been shifting, interest rates have been shifting, so many of the targeted orders that we were expected to win in the current year have got deferred to the following year. So I do believe that the decline that we have seen for the year as a whole in the domestic order is nothing but an event postponed. When it comes to order book, we are at, as I told you, 3.5 trillion rupees, which is a 9% growth over the 3.27 trillion of the previous year. And 27% of our order book is in international orders. Where did we get our orders from? 48% from infrastructure and 25% from services and 16% from hydrocarbon. These are the three big pieces that has moved the numbers insofar as order inflow is concerned. The order book consequently has 73%, nearly 2.6 trillion rupees worth of orders to be executed in the space of infrastructure over the next 2 to 3 years' time, some of which as outliers could be over 4 years' time. Hydrocarbon at 16% is another big chunk in this pie, where orders, the order book is 564 billion rupees to be executed over the next 2.5-3 years. Coming to the segment performance, infrastructure segment has done well during the year, and it's very important that this segment does well for the company to report overall good numbers. If you see, the order inflow has been robust. The Q4 has order inflow of 450 billion rupees, which is 44% growth over the 312 billion rupees of the previous year. Year as a whole is at 935 billion rupees, less by 8.9%, and we did mention just now the reasons for that decline being deferment of many of the targeted orders to subsequent period. The net segment revenue from infrastructure segment is grown by 13% for Q4 and nearly 18% for the year as a whole. This is indicative of the fact that the execution pace has picked up through the difficult year that we traveled through, and it appears to us that this pace could sustain into the current year. EBITDA margins at 9.2% for the quarter and 8.2% for the full year indicates a decline of 2.3% for the quarter and 0.3% for the full year. As I mentioned to you, it's a combination of cost overrun, the kind of jobs that have come for valuation in the respective periods, and the provisioning that we need to carry in our books as the jobs get delayed because of the supply chain constraints, etc., and some delayed settlement of claims that we have preferred with our customers. A combination of all that has meant a 30 basis points reduction in our infrastructure segment for the year as a whole. Hydrocarbon segment had a bumper year in terms of orders. We won 74 billion rupees worth of orders in Q4, and that's over 100% growth over the previous year's Q4, and 309 billion rupees for the full year, which is 74% as compared to the previous year. As you can see, almost 80% of the orders that we have won for the year FY22 for hydrocarbon business is from international markets. The segment revenue for the hydrocarbon segment is up by 13% for the year as a whole at 191 billion rupees, and for the Q4 it is down by 3.2%. And the temporary disruptions in the supply chain and the procurement programs of Q4 has led to this decline, and we do think that the subsequent quarters we would be able to do the catch up. EBITDA margins for the year as a whole is at 8.7%, 40 basis points lower than the 9.2 of the previous year, and at 9.7 for the quarter, which is 2.8% lower in Q4. It is important for us to know that the Q4 of the previous year had some favorable settlements with the customers as we closed out some very large value jobs both in Middle East and India. And whenever we have these large closeouts and the final settlement take place, the quarterly margins does undertake some spike, and that is evident in that 12.5% of the previous year. Whereas on a normative basis, 9.5, 9.7 appears to be more in order. Power segment, I think it's a segment under transition. We are trying to, like many in the sector, migrate from black energy to green energy. The opportunities that are available for coal EPCs have been very, very limited. The opportunities that we see today are more in the area of FGD projects, which is flue gas desulfurizer. It's part of converting the pollutant into a cleaner form. These orders are, as you know, much smaller in value as compared to the large EPC orders. And the entire EPC segment, which is active in this space, is after these small FGD orders. So the competitiveness here is of key. We also see not much of gas prospects in India. The prospects that we see in gas is more in the neighboring region like Bangladesh. So to some extent, this segment will have limited volume, but what we need to watch out for in this segment is its seamless transition from coal-based projects to greener form of energy. The order inflow that power segment reports for the year FY22 is 13 billion rupees, which is still 38% higher than the 9.8 we reported last year. But these are really comparing small numbers, so percentages have limited significance. The segment revenue is at 44 billion rupees for the year as a whole, which is again 39% higher than the FY21 segment revenue. But the matter that we need to watch out for is the order book is getting depleted as we keep executing these orders and are not getting sufficiently replaced. So consequently, these revenue lines will sort of come down over time and get substituted by alternate forms of energy that we will seek to do EPC business in. The EBITDA margins at 3.9% for the full year and 5.2% for the quarter are representative of the kind of jobs that we are currently executing. These, of course, do not include the profits of our boiler and turbine JV, because those are accounted at PAT level and not reckoned in our financial charts at EBITDA level. Heavy engineering segment has had to endure a very difficult year. I think this was the year where, because of the volatility in the energy prices, much of the programs that involved erecting heavy engineering equipments, ordering heavy engineering equipments, were put on hold. So there have been considerable amount of delays in project awards and quite a bit deferments too. So consequently, the orders won by the heavy engineering segment for the year is at 32 billion rupees, is nearly 10% lower than the 35 billion of the previous year. And for Q4, singularly, at 7.2 billion rupees, it is lower by nearly 60%. Of course, the quarterly arrangement of these orders are a product of when the award gets announced and when the awards are converted into letters of intent. So limited significance from a quarterly point of view, but from a yearly point of view, it does signal the delay that is featuring the decision making of all the refineries both in the country and out of the country. As you know, this business does fair bit of equipment supply globally as well. The net segment revenue at 27 billion rupees is around the same trajectory as it was in the previous year at 27 billion rupees. And the late receipt of orders have also resulted in the ramp up of revenue not being visible in this year's revenue statements. The EBITDA margins at 19% is down nearly 80 basis points as compared to the previous year. And the previous year had the benefit of certain price variation and early completion bonus from some of our customers, and that is why you would find in Q4 of the previous year we reported an unnatural 29% margin. This wouldn't come out of normal operations but for these bonuses and price variation claim settlements. Defense engineering has had a good year in terms of order inflow. The fourth quarter ended March 22 saw defense business pick up 53 billion rupees, which is more than 100% of the 2.8 billion of the previous year. And for the year as a whole at 80 billion rupees, again 3 times more than the 24 billion that it won in the prior year. It is heartening to note that 50% of this 80 billion rupees is orders on the shipyard. And the shipyard, because of the capacity that we have built in the yard and the sophistication that these capacities carry, it's very important that we keep getting large orders in the shipyard to reduce the under recovery. So it is hence, from a mix point of view, a very positive development for the current year. The segment revenue at 32 billion rupees is down by 5% as compared to 34 billion rupees of the previous year for the year as a whole. And for the quarter is down by 21% at 8.9 billion as compared to 11.4 of the previous year. Last year around this time we were at the peak execution of the orders that we are due to deliver both in the shipyard and in the defense space. So consequently, both the revenues and the margins of the previous year were reflective of the scale up that was happening. And as far as the current year is concerned, at 20% margin, it is 2% lower than the FY21 for the year as a whole. IT and technology services segment is nothing but a summation of the 3 listed entities that we have. All of them have reported robust top line. And what is most heartening about the top line growth is the accompanying profitability as well. Not only has the revenue grown by 26% at 322 billion rupees, but the profits have also grown by over 30% at the bottom line. And that is evident in the EBITDA margins being at 23.6% on a scaled up revenue. As you know, much of this business is international business, and hence the robust deal pipeline that we see as companies begin to transform themselves into a different business model, get more tech enabled, get more cloud in terms of infrastructure. All of this augurs well for the growth prospect of this segment going forward. Each of the company has its own unique offerings for some select segments, and that way they've been able to complement the portfolio's growth overall. Financial services segment is a segment under transformation again. We were in preparation for being a bank many years ago. We arranged our businesses in a manner which could mirror an ultimate migration into a banking setup. But now that the regulations are fairly clear, at least to us, that the financial services business, especially sponsored by an industrial house like us, is more likely to exist in a non-banking format. We have made a conscious decision to shift away from the wholesale segment and move to the retail segment. And what this would mean is growing portfolio of our retail assets, both urban and rural. And to enable us to manage the volume and the scale in a profitable manner, we also will dip deep into our digital technologies to make sure that we are able to track customers, convert them into convert interested people into our customers, deliver them credit, and also be able to monitor and collect our receivables back from them. So the entire cycle of credit identification to credit delivery to collection back and upselling and cross-selling going forward would all be enabled by this technology that we are planning to deploy. So consequently, while the volume of this business would be smaller, the profitability is expected to be better. So in a manner of speaking, we are adopting a strategy of shrink to grow as far as financial services business is concerned. Notwithstanding this, the net segment revenue at 119 billion rupees for the year is 11% lower than the previous year, largely arising out of the shrinkage of the book that I spoke about, whereas we move away from wholesale assets and move closer into retail assets. However, the migration is a profitable one, and hence the reported PAT at 10.7 billion rupees is up 10% for the year as a whole and 28% for the quarter. The PAT, net of the minority interest holders, are at 6.8 billion rupees, which is an 8% growth over the previous year, which is our share of profits. The development project segment is largely the revenue and the PBIT are reflective of the Nabha Power that we run. It's a coal-based power plant in Punjab, as well as the Hyderabad Metro. The revenue from both these assets are at 11 billion for the quarter and 43 billion for the full year. The revenues are up 20.6% for the full year, largely on account of higher PLF of the Nabha Power Plant and improving operations of the Hyderabad Metro. These improvements are also visible in the losses being reduced. PBIT margin, which was minus 7.8 in Q4, has reduced to minus 5.5, and which is minus 7.1 has reduced to minus 5.9. We do believe as the Hyderabad Metro asset begins to get more streamlined, both in terms of traffic ridership as well as capital structure, we should be able to hopefully report better numbers going forward. And Nabha, as you know, is an asset that we intend to divest at some point in time, but it is a good asset, so we don't want to throw it away without appropriate value. So we will run it well until we keep it. The other segment is nothing but an aggregation of realty, industrial machinery and products, namely construction, mining equipment, tire curing presses, etc., and the digital businesses that we run in terms of Smart World and the platform businesses, EduTech and Sufin. EduTech and Sufin is absolutely the babies in this portfolio, so there's not much of numbers that I would report for FY22, but the rest of the business, particularly realty and industrial machinery business, have shown healthy growth in FY22. That's visible by the 32% growth in order inflow and a revenue of 59 billion rupees as compared to quite similar number in the previous year. The margins from these business, again, is a combination of when we deliver the completed projects. In reality business, we reckon sales only when the projects are handed over. So it's not the way we account our construction business. So there's no progress revenue recognition. The margin is only when we sell. Whereas the industrial machinery products has been done well because this construction business has done well. And the projects that are under execution requires these machineries. So they've all grown by 30%. And we do think that the year ahead looks promising for this segment. Now moving to just 2 slides on future. I've been speaking about what we have done in FY22. Looking ahead, just as a broad guidance, we do look at FY23 with hope and optimism. We think both the revenues and the order inflow would increase between 12 and 15%. I'm giving a range because it's difficult to be very precise in our business, and we do expect to recoup some amount of that 100 basis points margin that declined during the year. So as against possibly 9.1% at the EBITDA level that we would be reporting, maybe it will move up to about 9.5, and it would be our endeavor to get there. But looking beyond FY23, we just completed as a company our plan till FY26 with FY21 as the base. As you might have heard before, we have a 5-year plan that we do. And looking at that plan, there are 3, 4 or 5 major strategic pillars that we are driving. One is all the businesses that will form part of our core businesses would be value accretive in its way forward. What it means is very targeted selective bidding and razor sharp execution. We also would reduce our exposure to non-core business, particularly the concession business. The idea is to become asset light while getting more profitable. We would also, as I mentioned to you in the context of power segment and hydrocarbon segment, we would transit into a green energy portfolio of businesses, and that will have multiple opportunities for manufacturing, projects, services, and even development. So consequently, this vertical would emerge over the next 3-4 years as a prominent vertical. We also have, as a part of this plan, decided to scale up our digital and e-commerce businesses. The 2 e-commerce business that we just, I mentioned to you, we just launched, will possibly gather pace during this period. And our IT businesses will continue to grow, if possible, even at a faster rate than what we are currently doing. All of this has to be achieved with business sustainability in mind, because I think the world is beginning to focus on the ESG scores, and we are actually, as a company, not blind to that. In fact, for many years, even before the ESG became a little fashionable as it is today, the company has been focusing on things like, water harvesting, planting trees and stuff like that. Because in the process of our construction business, there is a lot of destruction that takes place. And in any case, as a company committed to social welfare, we keep replenishing the resources that we use. So this is something that is going to be an additional fillip for us, and it only augments our belief that we have to do more for the planet. Looking at what the targets then could be, I'm just basing it on FY21 because the period is really FY21 to 26, and FY22 is the first step in that direction. From an order inflow level on a yearly basis of 1.7 trillion rupees, we hope to end FY26 with 3.4 trillion, a growth of 14% through this period. There could be yearly variations, but that is fine. That is par for the course. This is just to set the direction and context. Likewise, based on these order wins, the revenue should be able to double as well, from 1.4 trillion rupees in FY21 to 2.7. And the ROE, which is at 10% in FY21, is expected to get to the trajectory of 18% by the time we end the year. So the idea of this plan to make sure that we become more sustainable, we become more valuable, and we create wealth for our shareholders. So thank you so much, and I'm glad SNS has joined us, and we'll open ourselves for questions.